Great. So welcome to our free session, courtesy of RCM Online College. And I want us to look at a question from financial accounting parts, right? It is the introduction actually of what you'll be meeting at intermediate level and also advanced level. At foundation level, we call it financial accounting. Intermediate level, we call it financial reporting. Advanced level, we call it advanced financial reporting. That is what we have. So I want to just go to FA, course outline, and put something to do with preparation of financial statements. Yes, the normal financial statements. That is income statements, right? Income statement and statement of financial position. When you go to financial reporting, it will not just be a simple thing. Of course, here you classify, you group everything that you are having. You just list them the way you have, right? All the prepayments, all the expenses are normally listed, especially the income statement. All the assets, liabilities are normally listed in the statement of financial position. But now, when you go to financial reporting, we talk about it as published. We now change the name. Published financial statements, right? Income statement and statement of financial position. In other words, we will not go to the income statement and list all our expenses. No, we'll put them into some category. For example, all administrative expenses, all selling and distribution costs will be grouped together. We don't record individual expenses, right? We don't record individual expenses. Somebody saying that the sound is not clear. Somebody saying the sound is letting us down. How about now? Is the sound issue sorted? Or let me just see if we can have it here. Good. It's sorted now. Confirm whether the sound has now improved. Confirm. Any improvement on the sound? Any improvement on the sound? Is it okay now? Is it okay now? Thank you. Good. So that's what we're going to look at, specifically income statement, statement of financial position, then the publication of financial statements ready for publication. Right? Good. So whatever you normally see in the companies that publish their financial statements, that is the format that we are going to use to do the publications. But at this level, allow me to do the question together with you by just looking at the components that are actually given there. So the question reads, that is question number 4. Question number 4B, to be specific. Question number 4B, to be specific, right? So the question says that the following trial balance were extracted from the books of Bella Omari, a sole trader as of 30th September 2024, right? So I'm also addressing a question where at this level, we are normally taught about journal entries, right? You do journal entries, you come up with the ledger accounts, then of course, you give us the closing trial balance. So that is basically what we have here. And for every debit, we must have a credit. I think that rule is clear to all of us. Those who are in this class understand that for every debit, we must have a credit. So we have capital, purchases, sales, return outwards, return inwards, discount, allowed, discount received, wages and salaries, rates, insurance, and all that. Everything is listed there. I want you to just take 1 minute, if possible, right? So 1 or 2 people can start from the debit column. Just add all the figures in the debit column. Another person to add the figures in the credit column to confirm to us that indeed the closing balance there is 89,64,240 and 89,64,240 for the credit balance or credit figures. Please just do that within 1 minute. Do that within 1 minute, then we agree on what to do. Confirm that the figures in the debit side and the credit side are actually adding up to the same amount. Because if that has not happened, no matter how accurate you are, the statement of financial position will not balance. So you have to make sure that it's balancing from the one go. Confirm. Confirm. Give us a minute to do that. A minute is enough for us to confirm that the balances on the debit and credit side are actually equal. Confirm. We're getting the same amounts on the debit and credit side. Are we getting the same amounts on the debit and credit side? It has to balance from the beginning. If it is not balancing from the beginning, we have a problem. We will not balance the final question. Good. I hope you've confirmed everything is okay. Is that correct? Confirm that everything is okay, please. Confirm that everything is okay. Confirm that everything is okay. Can we proceed now? I hope everything is now okay. So after looking at that, we have additional information from number 1 to number 9. Every single additional information will be adjusted by doing what we call journal entries. So I want us to do the journal entries. And that is also another topic within FA. So let's start with the first one. We have information number 1. We have been told that closing inventory was valued at 222,600. What we need to understand from the word go is that closing inventory normally affects these two statements, income statement and statement of financial position. When you're dealing with the closing inventory in the income statement, what do we normally say? Income statement, so you have to debit one account and credit another account. What do we normally do with the closing inventory in the income statement? Somebody should talk to me. Somebody should talk to me. When you prepare statement of profit or loss, you normally say opening stock, add purchases, add carriage inward, right? Then less return outwards to get cost of goods available for sale. Then we less closing stock. So when you less closing stock on the debit side, we can also do something to effect the same. Instead of writing less closing stock, if you want to follow the journal entries approach, we are going to credit it, right? So we will be crediting closing inventory, closing stock will be credited in the income statement, all right? In the statement of financial position under current assets, what do you normally do with the closing inventory? It is added there as an asset. So the same closing inventory, right, the same closing stock will be debited in the statement of financial position. So for every debit, we have been able to create a credit. How much is the figure? 222,600, 222,600. That is number 1, right? Number 2, additional information number 2, we have, as of 30th September 2024, rates paid in advance amounted to 10,500. So the payments that are made in advance are normally recorded as assets. And the advance payment reduces the expense balance. The advance payment reduces the expense balance. Now, the moment you talk about an asset will be debited. So we are going to do what? We are going to debit. We debit the prepayment. Which item is this? Prepayment of rates on rates. Prepayments account, and of course, we're talking about rates. Then, which account are you going to credit? Remember, the prepayment is reducing the expense account. So look at our trial balance. Do we have an existing rates account? Yes, we have the rates account. You're going to do what? We'll be now crediting the rates expense account. rates as an expense, right? By how much? Or with how much? 10,500. 10,500. Good. That is what we have there. Sound still not clear? Is it affecting everyone or just one person? This sound issue. On and off. Good. How about now? Is it now sorted forever? Is it now fully sorted? It's not clear. How about now? Confirm to me whether it is correct, okay or not. Is there any change? Any change on the sound? Yes, there's some change. Great. Let us move to the next thing. So we have talked about the rates here. Then number 3, additional information number 3. Information number 3, we are being told that as of 30th September 2024, outstanding electricity expenses amounted to 5370. This is included in the general expenses. So in our question, we don't have an existing electricity expense account. The electricity expense is part of the general expenses. That is why it has been put. Now, the main thing we are going to focus on here is the liability, the outstanding. Any expense incurred and not paid for automatically goes to the liability account. Any expense that has been incurred but not paid for automatically goes to the liability account. So when we talk about outstanding electricity expense which has not been paid, then it means we're talking about a liability. So we are going to debit one account and credit another account. A liability, increase in liability will be credited. So we talk about accrued electricity or electricity payable. Electricity expense payable. So accrued electricity or electricity payable. The secret here is identify one account which you are sure of how it will be affected. Then the other one automatically will appear. Right? So for example, I know liability will go to this account. So which other account will be affected? We expect the electricity expense account to be increased. But since we don't have specifically electricity expense, where is it categorized? It is under general expenses. 5730, 5730. That is what we have in that particular section. Good. We are done with information number 3. Number 4, the trade receivables include an irrecoverable amount of 8,400. In other terms, we refer to it as bad debt written off. Somebody has been declared bankrupt and they owed you. You can never get that money. That is something you should forget about. The same case, this amount is irrecoverable. You cannot get it. Right? So what do we do? And remember, you record it as part of what you are owed by your customers. Right? Or let's say, God forbid, somebody came, purchased goods from you, and 3 months or 5 months down the line, you realize that this person died. It is very difficult to recover that debt, right? So what happens? You simply write it off. Now, that kind of scenarios is what happened to this company under additional information number 4. They could not recover that. So what do? We reduce the trade receivables. So trade receivables is an asset. Trade receivables is an asset. So when we reduce an asset balance, we credit. Trade receivables is an asset. Which account is affected? We're talking about bad debts written off. Right? So recovering of bad debts written off, which is an expense account with 8,400. 8,400. So we can have captured that particular item. That is information number 4. Number 5, a 5% allowance for doubtful debt is to be made on the remaining trade receivables. Do we have any other item that is affecting our trade receivables? The answer is no. The only thing we have is the bad debt that has been written off. Then, of course, no other item is affecting our trade receivables. Unrecorded trade receivables, we don't have any. Just that. So let's go to the opening trade receivables balance. Trade receivables balance, we have 552,000. I want us to adjust it this way. So, trade receivables balance is 552,000. 552,000, right? Yes. Now, this trade receivables of 552,000, something happened. We need to less this, trade receivables or bad debt item also. Less bad debts written off of 8,400. What is the remaining? What is the balance of the trade receivables? So balance before adjustment for provision. Before adjustment for the provision. When you take 552 minus 8,400, what are you getting? 543,600. Thank you. 543,600. That is what we have. Yes. Now we have been told how much is the provision. We are told under information number 5 that 5% allowance for doubtful debt is to be made on the remaining trade receivables, right? So, provision, talk about provision for bad debts is 5% of the closing. So don't do a mistake of taking 5% of 552. No, we have to check first of all the additional information to check. Do we have anything to do with the bad debts written off? Do we have maybe recoverable bad debt that was not captured? Do we have bad debt that was also not captured somewhere there? We bring them all together to this figure. So we have 5% of the adjusted amount, 543,600. What is somebody getting? What is somebody getting? 5% of that? 27,180. 27,180. Perfect. Now we have 27,180. This provision for bad debt, this is what we are going to have under current liabilities at the end of the year. In other words, just put it in bracket and say closing. Just say closing provision. Right? Closing provision. Just say closing provision. Do we have opening provision or provision? So at this year we don't talk about opening and closing. Just say provision for bad debts. Someone who has been able to attend financial accounting class will not say opening provision, but will tell us provision for bad debts brought down. Then will tell us provision for bad debts carried down, the closing balance. Go to the trial balance and check. Do we have opening provision for bad debts? Do we have provision, opening provision for bad debts or expected credit loss? Do we have such? Do we have? We don't have. So, opening provision at the beginning of the year, let me pick it from this point. Before you joined the class, like now, somebody is planning to join our classes and say, in the month of February, you came up with a budget or an estimate and said, let me put aside 9,600 to prepare to do my CPA. Or let me put aside, yes, you put aside 9,600 to do my CPA now. So when you come to RCM now this semester, you find that maybe retreat fee is the same amount, 9,600, right? So you provided to spend 9,600 and you ended up actually spending 9,600. Then somebody also, that's option one. Option two, which now relates to what we're doing here, is that you did not make any budget. You did not make any budgets. Where we got to Kasema, the way I've been able to join this FA class today, I can see this is the right place. I should join this school to do my CPA. So there was no provision. Initially, there was no provision. Now that you've been interested or you've been persuaded by how RCM teaches financial accounting, what have you decided to do? You have decided to join them for financial accounting. So you've been talking about 5,200 as the amount you need to spend. You had no provision, but now you have spent 5,200. What does it mean? It means there's an increase. You did not plan for this expenditure. So that automatically becomes an expense. At the beginning of the year, there was no provision. At the end of the year, we are anticipating that 5% of these outstanding trade receivables will not be paid, or they are going to default. So the amount we are putting aside is 27,180. In the event that they default, you've taken we call it internal insurance or self-insurance. In the event that they default and they don't pay, already you have a provision that you was in place. Right? So this one will actually cover that lost amount. Now, we need to look at it from this point. Are we talking about increase or decrease in provision? If you provided nothing, and at the end of the year, you have provided 27,180, it means you've taken money and put it aside for that purpose. Taking money and putting it aside means it is an expense. So increase in provision, like in this case, represents an expense. Right? Good. Then somebody is asking me an interesting question. I love that question. What if the company had a provision at the beginning of the year, let's say 27,000? At the beginning of the year, the company was having provision of 27,000. So you're able to put aside 27,000 to use it, only to realize that the prices have slightly increased. So you have now 27,180. The question is, already have 27 that you're able to put aside. How much will you add? The extra amount you are adding represents additional expense. Right? Is it making sense, Mercy? The extra amount we are adding here from 27 to 27,180, it means we have to spend an extra 180 shillings. So that 180 shillings becomes an expense. Right? It becomes an expense. Good. That is option one. Option two, you provided 28,180. 28,180. At the beginning of the year, you had a provision of 28,180. Then, at the end of the year, you now have closing provision of 27,180. In other words, you paid your budget. When you come into RCM this semester, like that is last semester, you say, maybe put aside, I know RCM charges school fees of 50 what? Let's say, let's talk about just something like this, 4800 per unit. So you are planning to do your financial accounting, right? Then you are able to put aside 4,800. Then, when you go to RCM the first day of the semester, they tell you, we will have 10% discount. You pay in full, you enjoy 10% discount. So you said, yes, I only need financial accounting. So when you got the discount, you are actually charged 43.20. Initially, you're able to put aside 4,800 to study your essay. When you came to RCM, you are given a discount. So you actually paid 43.20. Is there something you've kept for yourself? If yes, how much is it? Is there something you've kept for yourself? If yes, how much is it? 520. Is it 520 or 480? Somebody is trying to go. $480, right? 480. Whatever you've kept for yourself, you provide it to 𝗙𝐵 CPA, but you actually charge less amount. So that less amount that you've been charged, the reduction or the difference, that is what we call decrease in provision. Decrease in provision is an income because this 480, you will be retaining it. It is now remaining. Already, when you you forgot about the 4800. You say, this money, it's okay, it will be for financial accounting. But at same Akwambia, when you pay 4320. So the remaining 480 is something we are keeping to yourself. That is an income, right? You do not plan to have it, but because of the discount, you are now enjoying the 480 shillings. So it means decrease in provision is an income. Decrease in provision is an income, right? So somebody was asking me a question. Should I add that amount to 8400? No. 8400 ni ile mtu akona deni yako lakini amefungwa. You cannot go and claim this money from the person, right? 8400 is somebody who owed you, but something happened. This person died, right? You cannot go to this person's grave and claim the 8400. You forget about it. You write it off, right? So when we talk about the provision, it is paid on the remaining amount after doing the adjustments. So let's come back to our question and look at the reality. Let's come back to our question and look at the reality. So we want to just start. This person was not bothered about possibility of some people defaulting. So there was no provision at the beginning of the year. But at the end of the year, he was told, please just put 5% of the remaining amount. So 5% of 543,600 is giving us 27,180. There was no amount put aside at the beginning of the year, which means if this is to happen at the end of the year, the entire 27,180 will be treated as an expense. So increase in provision is 27,180, and the entire amount becomes an expense. So the next thing we're supposed to do, can we generalize that transaction? We are going to debit. We'll be debiting. Increase in provision is an expense. With debit increase in provision as an expense, then we credit. Remember, this increase in provision will be affecting our trade receivables, but not directly. It will be affecting our trade receivables through provision for bad debts. So at the end of the year, we now have provision for bad debts. How much? 27,180. 27,180. Can we try and now get the net trade receivables that we are going to record in the statement of financial position? So net trade receivables. Net trade receivables we are going to record in the statement of financial position will be disadjusted, right? Then we less the closing provision, right? In other words, we'll take 543,600 minus 27,180. So can we get the amount? Can we get the amount? If 543,600 minus 27,180. The 27,180 I'm referring to is the provision for bad debts at the end of this one. What will you have? It will take that approach. 543,600 minus 27,180. 516,420. Right? 516,420. Good. Can we just try the trade receivables T account? Trade receivables, or what you call ledger account, right? Now, the trade receivables ledger account, we have balance dot balance. So opening balance is 552, right? Then we're supposed to talk about the bad debts written off. So reduction in an asset account will be credited. So bad debts written off, that is 8400. That is 8400, right? Good. Then, what else do we have that has happened during the year? That's one thing we are having. So it will give us, this one here minus this, the balance carried down will be, the balance carried down will be that one there, right? So balance carried down, somebody should be able to give us that. 552,000. 552,000. I hope you are getting 543,600. 543,600. So I need to come up with a provision for credit loss. Provision for bad debts of credit, we call it also credit loss. That's the provision. So we have what you call balance. Brought down, opening balance 0. Then during the year, we have increase in provision, which is giving us closing balance carried down. So we are taking the increase in provision, which will be edited here. Where we need to go to? The increase in provision is an expense which will go to the income statement. So we talk about income statement here and talk about increase in provision. How much? 27,180. The account needs to balance. So since there is nothing else to talk about balance, right? Now, what do we have to make the account balance? 0 plus 27,180 is equal to 27,180. 27,180. Right? So what do we need to make this side balance? Of course, we need that 27,180. Right? So provision for bad debts having a balance carried down on the debit side. Trade receivables is having balance carried down on the credit side. So let's get the net amount. 543,600 minus 27,180. The balance carried down. The balance carried down. Is it true that that approach will take us to the same net trade receivables of 516,420? Is it true that it will take us to that point? Is it true? Thank you. So that is how we do account for the increase in provision for bad debts, and that's how we get our net trade receivables that will go to the statement of financial position under current assets. Under current assets. Let us go to the next one, the next information. So that has taken quite some time, but of course we have cleared it. The next thing we are having is number 6. Depreciation is provided at the following annual rates using the straight line method. Plant and machinery. So plant and machinery, actually, for you to know the number of years this plant will be used, it is very simple. Just go to your calculator, take 1 over, I can see 25% for plant. So 1 over 25% is the same as 0.25. You know the years. Furniture, I can see with motor vehicles, so 20. So 1 over 0.2, we know the years. Furniture, 12.5%. So 1 over 0.125. Good. Are you able to get that? Let's go to your calculator and put 1 over 0.25. What are you getting? 1 over 0.25. So this will be 4 years. That is the secret. 1 over 0.2. 1 over 0.2, 5 years. 1 over 0.125. 1 over 0.125. 8 years. That is option 1. So don't struggle with these things. It is just as simple as such. Right? Because some will be wondering, how can you tell us straight line method and you have not given us the number of years? You can get the number of years using that ratio. You can get the number of years using that percentage. And that's how we do it. Perfect. So let's proceed. Plant and machinery, this thing is happening on straight line basis, and therefore it is based on the cost of the asset. It is based on the cost of the assets. Can you adjust your mic, please? Does it mean the entity affecting us? How about now? Is it okay? John? Is it okay? Are we okay if you move that way? I can't hear you. Yes. Is it okay now? Is it okay now? Is it okay now? Can you confirm that? Tuko sawa? Yes or no? Are we okay? Great. So back to this place. Let's start with what we call plant and machinery. This is based on the cost because it's straight line basis. And we've been given salvage value of our asset. There is no salvage value in the additional information. So let's go ahead and calculate depreciation expenses. Depreciation expenses. So we start with plant and machinery. Alright, so plant and machinery, we have 25% on cost. What is the cost of this plant and machinery? You go to a trial balance. I can see the cost of plant and machinery, 1,600,000. 1,600,000. So please give me the depreciation. Depreciation of our plant and machinery, 400,000. 25% of 1,600,000, and total is 400,000. Right? Good. Now, once we have the depreciation, how do we account for that? How do we generalize it? This is the secret. So we debit depreciation expense account. Then we credit provision or accumulated. In this question, they are calling it accumulated, right? Accumulated depreciation for plant and machinery with 400,000. 400,000. So it is the accumulated depreciation that will be affecting our plant and equipment cost. So are we able to get the net book value? Are you able to get the net book value? Yes, we are able to get that. Look at the opening accumulated depreciation. So total accumulated depreciation of plant and machinery will be opening. Do we have opening? Accumulated depreciation of plant and machinery. You can see 447,000. 447,010 plus the increase. Remember, when we credit it, we are increasing that amount. Good. So what are we having in total? Is it 847,010? 847,010. Is it 847,010? Confirm. That is the total accumulated depreciation of plant and machinery, right? Total accumulated depreciation of plant and machinery. Now, how do we get the net book value of this plant and machinery? Net book value is the cost of plant and machinery since they are not purchased any during the year, right? Minus 847. So can we get the net book value of our plant and machinery? The net book value of our plant and machinery. 1,600,000 minus 847,010. What are we getting? 752,990. So 752,990. Please, when I request you to give me the net book value of plant and machinery, give me this figure. Give me that figure. Good. Let's move to the next thing. We are talking about motor vehicles. So motor vehicles here. Depreciation, we are told, is 20%. 20% of cost of motor vehicle. I can see motor vehicles is 843,000. 843,000. So what is the depreciation? Depreciation of our motor vehicle. 20% of 843. 168,600. 168,600. Now, once we have that, we are supposed to do the journal entry. So we debit depreciation expense for the motor vehicle account. Then we credit accumulated depreciation of motor vehicle with the same amount. So that is 168,600. 168,600. Good. Having done that, can we get total accumulated depreciation? Total accumulated depreciation for motor vehicle? For motor vehicle will be 168 on the opening. Let's look at the opening provision for depreciation. 168,600. 168,600 is the opening plus the same 168,600. Good. Are we able to get that total? Are we able to get that total? 337,200. 337,200. Good. Now, can we get net book value? Can we get net book value? So, net book value of our motor vehicle is the cost 843,000 minus 337,200. This net book value is what will be carried to the statement of financial position under non-current liabilities. How much is it? 505,800. 505,800. Perfect. We can finalize that part of depreciation with furniture and fittings. Furniture and fittings, we have 12.5%. So we have 12.5% of the cost of furniture and fittings. Furniture and fittings, I can see we have 245,000. 245,000. So can we get the depreciation expense for furniture and fittings? Depreciation expense for furniture and fittings. 12.5% of 245,000. 12.5% of 245, that is 30,625. 30,625. So we're supposed to debit depreciation expense, right, for furniture and fittings. Then we credit accumulated depreciation for furniture and fittings with the same amount. So 30,625. 30,625. Having done that, we need to get total accumulated depreciation. So total accumulated depreciation will be opening provision for depreciation or opening accumulated depreciation. I can see we have 14,240. So let's take 14,240 plus depreciation expense for the year, that is 30,625. How much are we getting in total as the accumulated depreciation? 44,800. 65. Can you confirm that? 14 to 40, 36, 25. 44,865. Are we getting that? Are we all getting 44,865? Yes. 44,865. Good. With the total accumulated depreciation and the cost of our furniture, which is 245,000, are we able to get the net book value? Net book value is equal to 245,000 minus 44,865. Right? What is the net book value that you give me when preparing statement of financial position? 860, not just 845, but 865. What will you give me as the net book value? 200, 135. 200, 135 is the net book value of our furniture and fittings, which will be recorded in the statement of financial position. So the income statement items are these depreciation expenses. I hope you've been able to factor them in. So I'll be requesting you to give me these figures. This depreciation expense, I'll be requesting you to give me 400 for plant and equipment. I'll be requesting you to give me 168,600 for motor vehicle. I will be requesting you to give me 3625, yes, 3625 for furniture. That is in the income statement. In the statement of financial position, I will be requesting you to give me this net book value. I'll be requesting you to give me this net book value. I'll be requesting you to give me this net book value. I hope to 𝐂𝐶𝐵𝐴 at the apple. But after dealing with the depreciation, I think we're almost done. Number 7. So we are told no depreciation is provided on the lands and buildings. So they are not being depreciated. If the examiner was to add something, maybe they could have revalued it upwards to give you the revaluation surplus. Then number 7, included in the wages and salaries is an amount of 93,000 paid to the domestic workers of Bella Omalu. So part of the wages and salaries is an amount of this one here paid to the domestic workers. The amount paid to the domestic workers means is not meant for business. You've withdrawn money, right? Ukona biashara unasema we nipatie 3 units, but you've not paid. Yes, the business is yours, but you should separate what you have and what the business is actually having. Yes, so that is what you're going to have as drawings, right? How will we deal with it? How will we deal with it? I think we have about 2 things to address there. So allow me to erase this. Allow me to erase this one here. So when you take money, you're going to debit drawings. Sorry. When you withdraw money from the business, so what I'm being told, included in wages and salaries is amount of this one here paid to the domestic workers, right? So the salaries and wages that we have, that expense is exaggerated, right? So we are going to debit drawings, then credit salaries and wages. Salaries and wages. With how much? With that exaggeration, 93,000. In other words, we are reducing what we call, we are reducing the salaries and wages. Is it possible to share the recordings in the LMS after the class? Yes, that would be possible. That would be possible. So that is number 7. Number 8, as of 30 September 2024, outstanding wages and salaries amounted to 37,200. Outstanding. So we are going to get it now again, salaries and wages. Then talk about the liability now, salaries and wages payable. Payable. Of how much? Payable of how much? Of the outstanding amount, 37,200. 37,200. 37,200. Hii salaries imesumbuliwa sana. Is it possible we get the net amount in advance? Yes. Let us look at the opening salaries balance. Salaries and wages. I have 933,000, so we have 9 salaries. 933,000. Now that is the amount given in the trial balance. The 933,000 we have seen we are reduced. That's an expense. So when you create the expense account, you are reducing it by 93,000. When you debit expense account, you are increasing it with the outstanding amount. Then we add 37,200. Is there anything here that was also affecting salaries and wages? We are not having any on this other side. So what is the net salaries and wages as an expense? 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 877,200. 877,200. 877,200. So that is what you are to do under the adjustments for additional information. So if we now go to the income statement, it will be a smooth ride. It will be a smooth ride. So here, I'll be able to recall the prepayments, the rates were to be reduced. Remember that general expense was to be affected by all this. So maybe if you can allow me, I can start from this side because I can see very few things are affected here. Very few things are affected here. So let's start with our income statement. So income statement. Income statement. We start with sales. Do we have the sales figure? The sales figure, our income statement. So our sales is given under information number 2952 to 40. I'll be able to see it also from usage 2952 to 40. To the sales, do we have return inwards? Return inwards will be affecting our sales. I can only see return, yes, return inwards are there. So return inwards reduces the sales. Return inwards is equal to 24 to 40. 24 to 40. So when we less the return inwards, it gives us net sales. Can we get the net sales figure now? Net sales figure. Net sales figure. Somebody to give us the net sales figure. 28,000. 28,000. That is the net sales. To the net sales, we need now to consider what we call cost of sales. So cost of sales, we start with opening stock. Opening stock. Do we have opening stock in the trial balance? Yes. Inventory as at 1st of October 2023 is 183,000. I'll be able to see that 183,000. Then you need to add purchases. We need to add purchases. All right. So the purchases figure, I can see purchases is given there. Somebody can also help us get it. The purchases is the first one, 1385,400. 1385,400. To the purchases, do we have carriage inward? So carriage inward is the cost incurred to transport goods to the company, right? Good. If you don't have carriage inward, then you need to less return outwards. You made purchases, but you returned goods. You return goods to your supplier. We have that. So return outwards returns outwards is 8,400. Is 8,400. Good. That should be deducted. It will give us goods available for sale. So to the goods available for sale, we need to less closing stock. Less closing stock. Remember the closing stock that we said will be credited in the income statement. So because we are doing this format, we simply put the negative. 3.2,600. When all that is put together, we will get cost of sales. So can somebody give us cost of sales? What is the cost of sales? 183,000 plus 13,85,400 minus 8,400 minus closing stock. Minus closing stock. So what are we getting? What are we getting? What are we getting is the cost of sales. 1337,400. 1337,400. Now, with that cost of sales, can you go ahead and give us gross profit? Can you go ahead and give us gross profit? Gross profit. 15,09,600. 15,09,600. 15, 15,90,600. 15,90,600. So the gross profit, we now bring in other income. Do we have any other income? Just go to the credit side of your trial balance. I can see capital, I can see discount received, so that's another income. Bank overdraft, of course, that's an expense, liability. So you only have one, right? Discount received. Discount received of how much? Discount received of 21,120. So that will help us to get what we call total income. What is the total income? 15,9,600 plus 21,120. 16,11,720. 16,11,720. Now, once that is done, we can now comfortably talk about expenses. Expenses, right? Now, these expenses, there are so many. These expenses are so many, right? We start with the depreciation, right? So if you start with the depreciation will give me depreciation for plant and the machinery. You will give me depreciation for motor vehicle, right? You will give me depreciation for furniture and fixtures. You can even list them here, no problem. So what is the depreciation of plant? How much was the figure? Depreciation of our plant, 400,000, right? 400,000. For our motor vehicle, depreciation expense for our motor vehicle, 168,600. For furniture and fixtures, 30,625. 30,625. There's another thing that you also adjusted: salaries and wages. Salaries and wages. Salaries and wages. What are the salaries and wages? The net amount. The net salaries and wages. The net salaries and wages, 877,200. 877,200. Those are some of the expenses we adjusted. Then we will talk about rates. So rates. right? Just have the 10,500, deduct it from the rates that is given there. So we have rates of, can you check 73,500 minus 10,500? 73,500, that will give us 63,000. With prepayments reduces our rates. Another item that was affected, let's see. General expense. General expense was affected. So let's look at general expenses. It is actually increased. General expense was actually increased. So let's start general expense of 121,800 plus 5730. 121,800 plus 5730. 121,800 plus 5730. 127,170. 127,170. Good. Then we also add bad debts written off. Bad debts. Bad debts written off as an expense. Do we have an existing bad debts written off? An existing bad debts written off, we are not having. So it will only be this one here, 8,400. Right? 8,400. Then we also add increase in provision and an expense, 27,180. So we have 27,180. Increase in provision. Right? 27,180. Good. Another one that I'm able to see directly is the discount allowed. Discount allowed is an expense. So discount allowed as an expense. Discount allowed. The company allowed some discounts. 27,300. 27,300. That is the discount allowed. Yeah. So we have prepayments. These are cool. You'll be able to give me this as an asset, this as a liability. Trade receivables, we have the net amount. Then of course, yeah, this one, I can read all this part. We are still listing the expenses, right? The ones that we're able to remember. So go to the trial balance and check. 121,800 plus 57 is 127,530. Are we adding or deducting? 121,800 is general expenses. So it's supposed to increase. 127,530. 127,530. General expenses. Do we have it already with us? General expenses. Ruth, confirm. Do we already have it? We have not captured that rate. The one we are having is the rate. The one we are having is the rate, which of course we want to. The rate is 60 what? 63,000. But it's written off. So something is wrong, right? Help me identify where the error is. There's an error somewhere. The rate figure 63,000 is okay. So bad debts written off should be, we should not have this one, 27,170. Is that what you are seeing? Yes, so this is the rates figure. Then we have bad debts written off, increase in provision, and we have discount allowed. So we are going to proceed with it and this part. Then we talk about general expense. General expense. So let's factor in that. We have 121,800 plus. Why are we adding? Because we are told there was an amount which is an accrual, the 5370. 5370 should be added to 121,800. Itakuwa ngapi? Electricity bill is 5370. Yes. So can you take 5370 plus 121,800? 5370 plus 121,800, 127,170. Thank you. Let us now go to the trial balance and start looking at all those items one by one. Have we taken care of capital? No, we are going to use it later. Purchases, yes. Sales, return outward, yes. Return inward, yes. Discount allowed, yes. Discount received was already used. Wages and salaries taken care of. Rates, yes. Insurance, right? Insurance. So insurance, what do we have? 53,400. 53,400, not affected in any way. General expense, trade receivables, trade payables, inventory. Drawings was affected by that we have capital and equity. Just all those ones for me. So can we get total expenses? Total expenses. Add all these expenses plus these two. What will you have? What will you have? Total expenses. But I can actually add the general expense and the insurance down here. Expense like insurance. So we have 127, 170, then we have 53,400. So let's put all the expenses. What are we getting? All expenses, all expenses. Somebody should be adding them. 400, 168, 600, 3625, 87, 7, 200, 63,000, 400, 27, 180, 27, 300, 127, 170, 53,400. So what are we getting in total? Total expenses 17. What one about different answers? Watch it on 1782,875. Somebody else to confirm or to give us the correct thing if what is given is wrong. Somebody to confirm by giving us the correct thing or to confirm that what has been given there is actually correct. Mm-hmm. 1782,375. I'm having three different answers. Let's see the fourth person. Let's see what the fourth person is getting. Let's see what the fourth person is getting. Okay. 1782,875. 1782,875. That is our total expense. So can we get profits? Profits? What's our profits? 11,720 minus 17. Profit or loss? Profit or loss? So the difference will be a negative. So how much is the loss? How much is the loss? How much is the loss? 171, 155. 171, 155. 171, 155. So it is very simple now to go to the income statement. I mean, statement of financial position. So we start with non-current assets. Statement of financial position. We start with the non-current assets. Good. Is it okay if we stop at that point? Will it be okay if we stop at this point? Or somebody is saying that we have to complete the remaining part. Will it be okay if we stop at this point? No, let's finish it. If 10 people will support that we clear it, then of course we'll do. If less than 10, you'll have to. So complete, at least 2 people are confirming that. Good, so we can actually enhance our speed to clear it very fast. So one of the non-current assets we said is land and buildings. Land and yeah, non-current assets we have land and buildings. We have furniture and fixtures of fittings. Furniture and fittings. We add plant and machinery. Plant and machinery. Then we add motor vehicle. So land and buildings was not being depreciated, right? So just put the figure, land and buildings 2550. We just copy and paste. Our furniture and fittings, you can now go to the net book values. Remember the net book values 1, 2, 3. Yes, that's what I want from you now. Furniture and fittings. Furniture and fittings. I want the figures from you. Furniture and fittings. Furniture and fittings. 200, 135. 200, 135. Plant and machinery. Plant and machinery. 752, 990. Okay. Motor vehicle. Motor vehicle. You have to copy the figures, remember? 505, 800. Good. So you have to go to the trial balance and check if we have any non-current assets. Let's look at the debit side. Non-current assets. We have calculated on the non-current assets. So you can move with speed and give me the total for the non-current assets. Total non-current assets. As we go to the current assets. As we go to the current assets. So current assets, we start with the inventory. Inventory, then trade receivables. Then we have cash, right? Then we have prepaid. It was prepayments. Prepaid. Oh, I'm given the figure. Why are we getting different figures? Ruth and Mercy are getting different answers. Tukiongeza hizi zote 25, 50,000, 200,000, 135, 752, 990, 545, 800. When you add all of them, the third person should be able to give us the answer to confirm between Mercy and Ruth who is right. The third person can help us there. The third person can help us there. $489.25. 489.25. Then the prepaid amount is equal to 10,500. Then inventory 226, 222, 600. Cash that was not affected 6,300. 6,300. Trade receivables, you have to give me the net trade receivables somewhere. Can you please copy it? Trade receivables. Trade receivables. Ilikuwa ngapi? Somebody. We wrote it somewhere. The net trade receivables. Somebody? Somebody should extract it from the workings. Our net trade receivables. Our net trade receivables was somewhere in our workings. 9, 516, 420. 516, 420. Good. Do we have any current assets that we have not captured? We eventually have captured, so let's look at the debit side again. Debit side. Bank overdraft is a liability. So we have captured all of them. Can we get total now current assets? So take 222, 600, 516, 420, 6300, 10, 500. And you give me the total. $809, $820. 809, 820. So total assets. Total assets in Gapi. Total assets, you check the non-current plus current. Your 809, 4818, 745, 4818. 4818, 745. Good. That is what we have. Right? So let's go to the equity. Let's go to the equity part. So equity and liability. Equity and liabilities. Right? Equity and liabilities. Now, under equity and liabilities, we start with capital or equity. Equity. So we start with capital. Our capital in the question, I can see 47, 48, 430. 47, 48, 430. To capital, we need to talk about the drawings now. Drawings. Now, drawings will appear twice. The first one is the one given in the trial balance, which is 312, 300, right? Then we also need drawings for the salaries that were for this person's domestic workers, which was adding up to 93,000. So these drawings, we need to add 93,000, right? So that will give us 5, 0, 4. 405, 300. Are you getting that? 45, 300. Yes. So I want to put 45, 405, 300. The drawings here, and of course, will affect our capital. Then, do we have reserves? Do we have reserves? Reserves. So reserves includes revaluation reserves, share premium, if we have that. So do we have share premium? There's nothing like share premium. This is not a public company. So the only thing we are going to have here is the retained earnings, right? We talk about retained earnings, retained earnings. Retained earnings carried down. How do we get retained earnings carried down? We look for the opening retained earnings. Do we have opening retained earnings? Do we have opening retained earnings? Look at our question. Opening retained earnings. On the credit side, there is none, right? We don't have opening. But I'm the one who is missing it out. We don't have opening retained earnings. So what do? We come and bring the loss. So opening retained earnings is 0. Then we have the loss, which is 171, 155. Right? This one is a loss. So basically we'll have 171, 155, but in negative form. So again, 171, 155 in negative form. Good. So that will now give us what we call total equity. So total equity or shareholders equity. So total equity, negative. Total equity. You take 47, 48, 430 minus 4, 5, 300 minus this because we have a loss. What are we getting as the total equity? Total equity, total equity. Somebody should be having total equity. 4171, 975. 41, 71, 975. For 171, 975. Now we go to non-current liabilities. Do we have any non-current liability? I can't see non-current liabilities here. I'm only seeing current liability. So to save on time, let me talk about non-current liability. There is none. Then I go to current liabilities. Oh, I have enough space here. I have enough space here. So non-current liability, I have 0. Right, so let me go to the current. So current liabilities, the first one, there's that accrued. Accrued are actually 2. We have accrued, number 1, look at number 3, accrued electricity expense. So electricity payable, right? We have that one. How much was it? Electricity payable was 5370. Then we also add some accruals there. Wages and salaries, no, but we have outstanding wages. The salaries and wages payable, 37,200. Salaries and wages payable, 37,200. All right, good. Any of that you're leaving out there? So once we are done with the adjustment, we go to the trial balance and check. We must be having trade payables somewhere. So we have trade payables, right? We have trade payables. Then we have bank overdraft. So trade payables, I can see trade payables is 483,600. 483,600. Then bank overdraft, I can see we have 120,600. 120,600. Good. So, any other liability that I'm leaving out? I doubt. So let's get our total current liabilities. Then we get now total equity and liabilities. Total current liabilities, Ningapi. Total current liabilities. Somebody. It seems Ruth is having everything. Somebody, 646,770. So we have 646,770. Good. Now, can we go ahead and take 646,770 is the current liabilities. Then total equity is 41,71,975. Can we add all that? In other words, take this plus this one here. What are you getting? Give me your answer. Give me your answer. Just give me that answer, then we'll agree whether we are disappearing. 48, 18, 745. 48, 48, 18, 7, 14, 5. So we want to come up with something here called check. We are going to check. Can you check that total equity and liabilities minus total assets is giving you 0? Can you check that total liabilities and equities minus total assets is giving you 0? Can you check? We are checking. We are checking. We are checking. As you check, have this number. As you check, have that number. Account, financial accounting. Account, financial accounting. Any inquiry, call 07 19 525 000 07 93 555 000. Check. Wait, so that is it. If you have not paid for these classes, please do, because we are going to do another question during the normal class. So don't miss that normal class. For you to be part of the normal class, do the payment to this pay bill so that you can join us officially, where we'll be addressing another question to look at the comprehensive part of a question like this one here. I think that marks the end of my today's presentation. It was great hosting you this afternoon, and enjoy the rest of the day. See you next time.